welcome back to Consumer Says, a biweekly podcast hosted by Morning Consult Economic Intelligence. I'm Sophia, and I'm joined here with my colleague Denny. Hello, Denny. How's it going today?
Hi, Sophia. I'm doing well. How are you?
I'm great. Happy spring. We have lots to discuss today. Before we get into the meat, let's remind everybody please sign up for our newsletter. I will attach a link in the description. It's a corresponding newsletter that comes out with this video every time we publish. So you can read our analysis, see the charts, dig into it a little bit more if the reading aspect of things is more enjoyable for you. But anyway, we have a lot to discuss today. The econ world has been super busy. There's lots of different data that has come in. There's lots of different economic policies that are being proposed, drawn back, reproposed, implemented. So we have a lot to get into. But the main topics we're going to get into today, first, we're going to do our temperature check, which will be on labor. And then, second, we will get into a discussion on our latest inflation report, which just came out yesterday. That's going to be rerunning a survey question that was really popular a little over a year ago. So I'm really excited to discuss about that. It's on consumers' perceptions of inflation and how it relates to their behavior and how they're perceiving prices and the economy as a whole. So, before we get into that, let's start with our temperature check. Denny, I wanted to ask you to lead us off today. What would you say is the temperature of the labor market? We got some new data recently, and things are kind of the same but kind of different. So, what would you say is the temperature?
So the temperature I would put at this point for labor market would be around 65. Again, the baseline is the sweet spot, as we like to call it, is 70. So we're certainly below that, but it's not significantly lower. Um, as I think about that 65 number, at the back of my mind, I have few indicators. One of them is the most recent employment situation report, and I will sort of focus on that a little bit more. The latest unemployment figures came in at 4.1%, which supports that 65 measure in a way that this is still a very low unemployment rate. So as Chairman Powell describes it, it still makes it a solid job market. Um, that being said, why are we not in 70? There are certainly threats on the horizon, and there are certainly some weaknesses that we already see in the data. Um, Talking about the weaknesses, I think the number one weakness that has been shown over and over again is that low hiring rate. What we have seen in what we already say in a lot of our analysis, if you have a job, you're good to go. But if you're looking for a job, if you're unemployed and you want to switch jobs, this is not a really good environment for you. And a lot of the data right now still shows that environment. And that's sort of number one. Number two is the federal workers, and we touched on this a little bit in the previous recording as well. We did not really see that number pop up in the unemployment numbers this month, but it does not align well with the timing of the cuts. So perhaps next month. Um, we did see some of the unemployment claims coming from the federal worker workforce. So therefore, we will perhaps see some effects next month. And as we've mentioned, it could have a bit more of a regional effect and perhaps spillover national effect on the unemployment rate. So that's the threat number two. Um, and although we do have low layoffs, as you've mentioned, happy spring. We're sort of in the spring period where we're going to have a lot of graduates trying to enter the workforce, and our latest analysis focused on that young workforce cohort, how it's going to be a lot harder for them to find a job this spring and summer. Um, we do see that for the older population as well, but as we've highlighted in the recent analysis, it's even harder for that younger cohort with not as much work experience to find the job right now. Um, we've mentioned tariffs. The way we view it, this uncertainty, as Chairman Powell also described in his latest speech, perhaps also affecting businesses to rethink hiring decisions. And we do see that in multiple data points as well. Perhaps they're in this wait and see mode. And that does certainly feed into that low hiring number as well.
Mhm. Yeah, I think we just passed a second round of delays for the tariffs. So the tariffs did go into place for Mexico and Canada. And still, the majority of them are actually in place because now they're being paused until April 2nd for all USMCA related goods. But it's still a good chunk of those goods, but a lot of them have been kicked down the road a little bit farther, including some of the ones that we were a little bit more worried about that we'll get into later actually in our inflation discussion, like agricultural goods. Um, but I think one of the big takeaways from this most recent punt in tariffs is that the uncertainty is starting to have more of an effect on the economy and markets than the actual tariffs themselves. So, when we first heard about the tariffs, we were really thinking about how this might affect prices, increase price pressure, have a one time change in the price level, which would affect the inflation rate. But now, with all this uncertainty, it seems like, as you mentioned, it could be more causing a drag in business activity because businesses don't know what to expect, what is actually real, what is going to go into place, how can they plan for that. So contracts might be being negotiated slower, projects might be slowing down because they want to wait and see, might not be a great time for hiring since we don't know exactly what's going on until all this uncertainty is starting to percolate and show up in various different measures. I thought it was interesting that after the Mexico and Canada tariffs were kicked down the road again farther, the market didn't really react positively the way that I think a lot of people expected it did, the way it did last time the tariffs were punted. So it seems like the uncertainty is really the big message from those now, and that could have more of a labor market effect than a prices effect, which is what we originally thought when we first heard about these tariffs. Before we move on, I did want to ask you more about the younger cohort. You briefly touched on it. So you put out a memo recently about how Gen Zers, especially those who are graduating high school or college and looking to enter the labor force, are facing more difficult conditions. Is there anything else that you want to expand upon on that before we move on?
Certainly. We looked at this data, looking not only at the Bureau of Labor Statistics data, but also Morning Consult Unemployment Index, which we had seen rising for a couple of weeks now, and it just finally started to turn. And what I've noted is that it hasn't really turned for the young cohort. So when you look at that prime age workers, you do see that turn, especially for the male. But you don't really see that for the young cohort yet. And it really, it's for those who have some college degree even. They do not see that relief. So what that tells us is that there's certainly a lot of competition right now for the very few openings and the hirings that are taking place. And younger cohort with fewer education, despite their education, might face a more challenging environment.
Yeah, and that goes hand in hand with what you said about the hiring rate. So it seems like businesses are slowing down their hiring a bit, and that could really hurt people who are entering the labor force or looking for new jobs because new jobs might be harder to come by. So that's definitely something to keep an eye on. Maybe not the best time to enter the labor force, not the worst time either. Um, as you mentioned, we're around 65 degrees for the labor market. It's not horrible, not chilly yet. Okay, should we move on to inflation?
Yes. So for inflation, for our listeners, we do monthly surveys on inflation and supply chains every month. And for that survey, we try to understand category level data. Are consumers walking away from purchases? Are they substituting purchases? Are they having delivery delays? For this report that we're going to talk briefly, it's what we call our one-off surveys, where it's perhaps not as much on the category level as it's more on trying to understand how consumers perceive inflation, get an understanding of what inflation means, how do consumers define inflation. So Sophia, why don't you tell me about what are your 3 or 4 key findings from our latest survey?
Sure, I'd love to. So this survey was originally inspired at the end of 2023 by all the Vibe session discussions about why the economy was doing so well, and at the same time consumers were feeling very unsatisfied with the performance of the economy. And we suspected that a lot of it had to do with inflation. So we constructed a survey without leading consumers, obviously, just to see what are their top concerns about the economy, how do they feel about prices versus wages, to kind of get a gauge on if it was indeed prices that was the real downer that was bringing people down. And what we found was a loud yes from our respondents, that it was inflation and prices that was the main concern for them. And so now, 2.5 years, nearly 2.5 years from its peak in mid 2022, inflation has come down quite a bit. It's not at that 2% level that the Fed wants it to be, but it's below 3%, right around 3%, depending on the measure. So quite a bit lower than when it was at its peak. At the same time, inflation, nearly 9 out of 10 consumers are still concerned about inflation. So that's almost everybody. And so that, I think that that's pretty striking to me, and it's nearly the same level as it was when we asked them at the end of 2023. So it hasn't really budged. It's still a big concern in the minds of most people. The other thing is that although this is a large concern, overall people feel better about the economy than they did a year ago. They feel better about it in terms of the index of consumer sentiment, which we've talked about many times on this podcast, but they also give the economy a better grade. That could be disturbed by some of the recent trends we've seen. So consumer sentiment has been dipping since inauguration, since the uncertainty we've seen with some of these economic policies, frustration with tariffs. Um, Federal workers might be particularly feeling bad about the economy. So there's some downside risks to that as well. But as of now, they're feeling better than they were a year ago. And then the last thing is that we have this one question that compares wages to prices, and we found once again, we'll get into that in more detail, but we found once again that people really hate high prices. They want inflation to come down, they want prices to come down kind of no matter the cost, and we'll get into that a little bit more in detail. And it goes along with some of our other data that you mentioned. We have our trackers, our monthly trackers for price sensitivity. People are as price sensitive as ever, more than ever, and it's showing up in how they respond to our surveys and probably how they will act going forward.
Fascinating. That last one, especially, is the most fascinating part for me. But before we get to that, I guess let's talk a little bit more about, inflation and costs. We did ask them about their concerns, and as you said, inflation is a big concern. Was there another concern that came close to that, 90%? And, perhaps we can talk about why,
Mm-hmm.
because we did ask a couple of different, indicators in there as well.
Right. So as I mentioned earlier, the whole inspiration behind this survey was trying to get at what was really bothering people about the economy and why did they feel so badly about it and not as good as they did about it before the pandemic. Was it just inflation? And it seems like it is costs and price related. Out of all of we gave them a laundry list of things about the economy and put up a chart here. But the top 4 things were all of the things that we asked related to costs, and then the 5th one was also kind of like a purchasing power thing. So the top one, always, we've asked this question a few times now, it continues to be grocery and food prices. That's at 90%. People are really worried about how much groceries cost, and that's something that's put a lot of pressure on consumers' budgets. The next one was just inflation generally. Following one was housing costs, gas prices, and then how the amount of money I personally have covers my monthly expenses. So those are all price and cost related. The other things, there is a majority of consumers who are concerned about other things, including employment rates, the GDP, etc. But they don't come close to this, nearly 90% total concern rate that we see from costs. So I thought that was interesting, because yeah, it just continues to be top of mind and the biggest concern. People really, we talk about the labor market and how that might be an issue going into this year, but for consumers, it's cost that is the big issue.
Yes, in this chart, we see the employment rates around 70%, stock part prices around fixed 55, 56%. That is drastically different from 90% for, grocery prices. And groceries is something that we often, especially when it comes to prices on the groceries, we encounter it quite often. Everybody does grocery shopping. So there's definitely that repeat exposure to prices on the groceries. One may follow the stock market or may follow the GDP releases, but perhaps it's not as apparent for them as, buying your milk, your eggs, your bread, your butter, etc.
Yeah.
But let's talk about the inflation rates for the groceries. It is certainly down from its peak, right? We are around 1.8% or so, close to 2% on grocery inflation rate. It is significantly lower than its peak in 2022 at 13%, which is very high. Um, why do you think people are still very, very concerned? Does this sort of go into the whole price versus inflation
Mhm.
rate discussion that we perhaps will talk about?
Yeah, that would be a great segue, but I do think it's related to prices versus inflation rate. So, yes, inflation has come down. It's actually, you said 1.8%. A lot of that actually ticked up recently, probably due to eggs because eggs have gone up so much. But so it's even lower if we probably take out eggs. That's pretty low. That's like below the Fed's target for overall inflation. So it's not bad. But we've found in our surveys time and time again that people don't think about inflation as this year ago change. They're thinking about a cumulative change, especially in just like their near memory. So in the past 5 years, groceries have grown around 28% in prices. So that's a lot more, and people are really frustrated about it. And as you mentioned, the stock market, GDP, like things like that, people pay attention to. Not everyone has equities, not everyone's invested in the stock market, but nearly everybody buys groceries. So that's something that we can all see and really feel on our wallets. And that's someone, no matter how much they pay attention to the economy and financial markets, that's something that they can feel and understand. So I think that's why that's such a big concern to people. Um, we've seen in our data, I'll put up another chart here, that actually there's a growing share of consumers who are saying not only that they're concerned, but that they're very concerned about grocery prices. This was the case amongst most of the demographics that we pay attention to in our survey data. And I thought that was also interesting because, we could see this getting worse depending on if we see agricultural imports being tariffed and taxed. That could put upward pressure on those prices and could really anger people because that's something that frustrates them more than anything, I think.
Yes. As you mentioned, the tariffs on Canada and Mexico, uh, the parts that's related to agricultural goods inclusive are exempt now until April 2nd. And Canada and Mexico are big top trading partners when it comes to agriculture products. So certainly a real risk in there to drive up grocery prices if and when these tariffs do go into effect on in April.
Mm-hmm.
And it could have spending implications.
Yeah.
Not every category, of course, but it could have spending implications on non-essential spending at the grocery aisles, as people allocate more money for the essential parts that now require more of their dollars.
Yeah, that's something that we talk about a lot is when things affect our essential spending, we're still going to need to buy those essentials. So, where do you make the cuts? Maybe you do make the cuts in your grocery budget first. You buy a generic brand or you cut out products that aren't completely necessary. But that can also spill over to other discretionary goods and services, depending on how how much your budget is squeezed. And something that we also shouldn't forget is that there might actually be tariffs also on the EU. It's been mentioned a few times as a
That's right.
potential for April, and they're our next biggest agricultural trading partner. So that could put even more upward pressure on grocery prices.
Yes, that's that's correct. Certainly more of their tariff options on the agenda. Um, we've talked a little bit about that price growth versus current level of prices. I guess, would you mind elaborating a little bit more if there was any change from when we've done the survey previously to now, or is that are those results mainly the same?
Yeah, so something that was also discussed a lot when we were back in the vibe session debate a lot was that it's not about inflation, it's about the price level. So as a reminder to everyone listening, most of you probably know, but inflation is actually price growth, whereas the level overall level of prices is generally always increasing. So if you look, this is why when you talk to your grandparents, they say, back in my day, I bought like a can of Coke for a nickel or whatever. So generally, prices just go up. There are small periods of time, if you look at a chart of CPI, where it does blip down, and you can see if we lay over the recession bars that they're usually coming in line with a recession or downward growth in the economy, because when prices go down, that usually means, it's not a good time to buy, and maybe people are being laid off and economic activity is slowing down. Prices don't just go down once they come up unless there's something else going on. There are like individual item prices go down. Sometimes people also get confused about this because TVs, for example, prices have gone down in recent years. That's due to productivity, not a general overall change in the price level. So, but everyday people aren't really thinking about price levels, price growth like we are as economists all the time, this is our bread and butter, but they just think prices are so much higher, and they think, especially compared to pre-pandemic, I think there's a pandemic effect here where we think about life before the pandemic and how it was so much better, and how sandwiches only cost $5, and so there's this idea of what a true price is, and it's tied into the price level. And so we have seen this also. We saw this when we asked in 2023. We saw it again when we asked in mid 2024. And then we saw it again in February when we just asked consumers again. They basically are just as worried about prices remaining above pre pandemic level than they are about prices growing. So that to me signals that to them it's frustration about where the prices are at, not just that prices are growing, which is why that I think that sometimes economists and people in the media are having such a hard time meeting consumers in the middle to tell them, inflation's cooling, inflation's come down, inflation's a lot better, because to them it doesn't matter because sandwiches now cost $12 and that's ridiculous to them. So that continues to be an issue in the minds of consumers.
Yes, and it's been almost exactly 5 years since the
Yeah.
pandemic started. So it's fascinating how that sort of is a very strong benchmark in consumers' minds, pre-pandemic, post-pandemic. And whenever they are making their references, it's really to that period before the pandemic started, as opposed to a year ago is typically, or month over month is how we like to do our comparisons. That really doesn't apply to your regular consumer who in their mind is still benchmarking everything to what it was like before the pandemic. So it's really fascinating to see that divide and how we interpret the data and how your regular consumer interprets the data. So what does the consumer prefer on prices? So what do they want, for to feel better? I guess if we go back to
Yeah.
the whole live session, what will make consumers feel better?
So when we originally were trying to answer this vibe session question, I thought to myself, do people just want prices to go down? Is that what will make them happy about the economy? Seeing that number going down on their goods and services? So we asked people, in order to increase your purchasing power, would you rather prices go down overall, or would you rather your wages go up? Because both of those have the effect of increasing your purchasing power. So what we saw in the end of 2023 and what we saw again when we asked again in February was that most people, this time it was 61%, want prices of goods and services to go down so that their money goes farther instead of their income to increase. So when we first published this back in the end of 2023, there were, it kind of went semi-viral. A lot of people had a lot of opinions about it. A response I saw a lot was that it was the altruistic thing to want prices to go down because prices would go down for everybody. But my feelings about that is revealing in itself, because if the consumer thinks that it's altruistic for prices to go down, that means that they don't really realize that deflation, what we mentioned earlier, is not an altruistic situation. That's going to be mass suffering because people will be laid off, the economy will slow down. That means that they think that that would be good for everybody, when in fact we know that that would not be good for everybody. So in and of itself, that's also revealing that they would prefer that. So we asked a follow-up question where we said economists predict that when prices go down, generally that there's a slowdown in economic activity, aka a recession. Would you still want prices to go down? More consumers shifted. So there was a majority of consumers who would prefer that prices not go down. But still, when we asked in 2023, and now again when we asked in 2025, still over a third of consumers would still want prices to go down, even if that means a recession. And so I have a bunch of theories on that, but why do you think that is?
Well, the first thing that I was thinking as you were talking is, we talk about prices go down, and connecting the dots between this and the previous conversation, I'm guessing that we haven't explicitly asked this, but I'm guessing that they not only want prices to go down, but they want it to go down to that pre-pandemic level, which if you think about, the grocery rate that we've talked about, that's more than 20%. So for that sort of price shift to take place, I would assume that the economic turmoil that we would have rather, would be quite detrimental to everybody. So it certainly would not be altruistic. Was the thought at the back of my mind. Um, but you did mention, why would people think about, prices going down, but economy, going into to recession. We did talk about a couple of examples on why. Um, I'm going to start with the easiest one. As we've mentioned, the inflation effect is very much accumulating on people, and that has resulted in what we can call at this point quite an extreme price sensitivity. That is, that is one explanation. Um, and the other explanation could be, we've also talked about this recency bias. Um, and this applies a lot for the younger cohort as well. There is not as good of a memory of the recession. We did have that pandemic shock recession, maybe we can call it that way. That was later eliminated from a lot of the charts we like to look at. So it's not, a lot of people, perhaps, especially the younger ones, have not experienced that recession. And for the older ones, it's sort of a memory back in the day, the Great Recession that they made.
Yeah. I think that it's important to note that the recession that we had during COVID was very different than a recession that is more traditional, because it was extremely quick. So we saw a huge decline in employment and a huge increase in unemployment, and it was a shock that happened very quickly. But then it also, as quickly, I mean, people said V-shaped recovery a lot of the times, bounced back. And so that's not really what we normally experience when we have a recession, because it wasn't man-made in that it was created because of the pandemic. It wasn't, but it was, a lot of it was due to the closures, which were policies man-made. So I think that's what's very salient in the mind of our younger consumers, especially because they think of that as a recession and they don't remember the Great Recession the way that our middle-aged or older workers remember it. Even the youngest millennials were probably around high school age or middle school age when the 2008 recession was really in its prime.
That's right. The final theory, so you and I have discussed this a little bit earlier. Losses for people are more psychologically severe than an equivalent win. So for people, it's perhaps easier in their mind to recoup their losses from dealing with higher prices and an equivalent gain through their income.
Mhm.
Um, how would you sort of elaborate on this?
Yeah, I think a large part of this is loss aversion. So, yeah, one way we have explained it or talked about it to one another is that if you have a unit change in loss, this and an equal unit change in gain, the loss feels twice as bad as the gain feels good. That's the idea of loss aversion. And I think that's kind of at play here also with prices. So people often feel it feels good to have your wages increase, but it feels worse to have something that you feel is not your fault happen to you, like prices going up. So it's the pain of losing is so much worse than the good feeling that comes from getting a gain. And then tied up in that, it's a little different than loss aversion, but I think tied up in that is also the idea of our own personal agency in the economy. So a lot of wage increases could feel because they might be tied to a merit increase or a bonus or something, they could feel like something that you earned because it is something that you earned. But also, when prices go up and wages go up together, some of that is also tied hand in hand where wages are due to this price level increasing. So some of it is also not because of you, but most of us feel that our wage increases are due to our own hard work and that we earn them. Whereas prices increasing are something that happened to us that feels really bad, that is a loss being inflicted on us, that is out of our hands and is, suffering or pain put onto us from someone else or the greater powers that be.
Right. So for the wage increase, perhaps the consumer feels like I deserve this. You know, the
Mm-hmm.
effect of that I deserve this feeling is a lot more than this is simply a cost of living adjustment.
Mm-hmm.
Versus on the price side, they perhaps are thinking, well, I did not deserve this. You know, I did
Mm-hmm.
not deserve to be paying so much more for the groceries or the gas or whichever category that they really closely follow. Um,
Mm-hmm.
so I do think that that sort of explained a little bit more of that, you know, especially that vibe session element that we've talked about.
And the other thing that we haven't gotten into, but we do get into the report if anyone wants to check out the demos. But something to keep in mind is that not everybody is participating in the economy the same way. So not everybody is earning a wage. And that can also change the way that you interact with wages and prices. So if you're retired, you're living on a fixed income, then price increases are much more painful to you than someone who's earning a wage and can benefit from the wage gains. So that's another thing that we have seen in our data. It makes sense, the people who respond the way that they do, because they aren't just your average worker. Because we have a whole economy full of different people. Not everyone's the average worker.
That's right. That's right. That's a really good point to end on. There's a
Yeah.
lot more in this report to look into. A lot of demographic cuts of the data to get an understanding if you're interested in different demographics.
Yeah, and we also get into implications because this is all interesting to chew on and think about, but there are implications at the end of this. The fact that we're, so many years away from inflation being at its peak, but people still feel this way. And we have all these price pressures that are percolating. What does that mean if we see inflation come back up again? And will we be able to get through it the way that we did last time? So that's something that we're chewing on in this report, but in a lot of our data going forward.
That's right. We are certainly not in the same space as we were last time when prices went up, especially when it comes to consumers' financial well-being. So certainly more to come on that one.
Yeah. Well, that we'll end it on that